Hey everyone, welcome to another episode of Adam Talks, a podcast that takes an alternative look at retirement. This is Adam Bergman, founder and CEO of IRA Financial. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hi everyone, and welcome to another episode of Adam Talks. I'm Adam Bergman, tax attorney and founder of IRA Financial. On today's episode, I'm going to be talking about a Bernie Sanders tax proposal. New estate tax and may be on its way. And this is a pretty doozy of a tax act if you are a generally high net worth taxpayer. This is something to be aware of because this could impact your tax planning for 2021. So this is called the For the 99.5% Act. So you could assume and expect that it's going after the rich. And it's interesting, if you actually take a look at the proposed legislation, Sanders actually includes a list of all the billionaires. It's crazy. So it's like a 20-page document, and it's like 2 pages of actually text, and the rest are just lists of billionaires. So you know who he's going after, and he's honest and upfront and saying, hey, this is a progressive tax. This bill is aimed to reduce the fortunes of the top 0.5% of wealthy Americans. And this is pretty much the first piece of legislation that was introduced following President Biden's coming to the office that would lower the federal estate tax exemption. So this is a biggie. This is the biggest tax legislation that's been proposed since Biden's taken office. It's not clear where this is going, and we'll talk about what it means, some of the key points of the 99.5% Act, but this is a doozy. This is a game changer, and it's important if you are in a somewhat of a high net worth category. And what high net worth is today is not what it means to Bernie Sanders. And we'll talk about the $3.5 million threshold, not the 11.7 or so threshold today. So it's going to significantly lower who is going to be attacked by the estate tax. And we'll talk about its impact and what you can do. So this is a bill that comes on the heels of a proposed legislation introduced by Senator Elizabeth Warren. That was on March 1st. That was called the Ultra Millionaire Tax, and it proposed a new federal wealth tax. So this is more targeted to estates. So here's some background. Since 2009, the amount of an estate's assets exempt from tax has risen from 3.5 million, and which is 7 million per couple, to 11.7 million or 23.4 million today, right? So you have a lot more room to go without paying estate tax. So just quickly, for those people who don't understand how the estate tax works, today, if you are married and you have less than 11.7 or 23.4 million in your estate, and that includes all assets, value of your cash, securities, value of your business, value of your real estate, even value of your life insurance, if that is less than the 11.7 or 23.4, you do not owe any federal estate tax. You may own state estate tax depending on where you live, but it'll be much less than the federal tax rates that can go higher than 40, 50%. So of the 2.8 million Americans who died in 2018, only 44,000 or 0.14% left estates large enough to require filing an estate tax return. So the estate tax is not going after a lot of Americans. It's going after the rich. And Bernie Sanders wants it to go not only after the super rich, but just the rich. So we're not targeting lots of people. Only 1,900 of the, or 0.6% of estates owed any estate tax. So even if 4,000 technically were subject to the estate tax because they had large enough estates, only 1,900 actually paid estate taxes because they actually had good lawyers. So that's going to be kind of a theme of this podcast, is that, hey, this is all great. Yeah, you may be able to at least on paper, claim that you're going to generate all this money. But guess what? There's very smart trust and estates lawyers. I've been doing some estate planning this year. It's not even complicated. It's literally just setting up a bunch of trusts, putting your assets in at today's value, using up the exemption, and then just having it all go tax-free out of your estate. So literally a first or second year estate and trust lawyer can figure this stuff out. So that's one thing I think Mr. Sanders is not understanding, that unless he gets rid of trusts and stops the ability to do irrevocable trust, all this stuff is going to be pretty much moot, because the rich people are not going to pay this tax. So in his mind, the fairest way to reduce wealth inequality is invest in the middle class and preserve our democracy, is to enact progressive estate tax on the inherited wealth of multimillionaires and billionaires. And that's the theme of and the impetus of his proposal. And he's trying to go after, obviously, the 0.5%. So let's talk about this. Right away, the act establishes new estate tax rate structures. 45% tax on value of estates between 3.5 and 10 million. So if you have a house, let's say worth 600 grand, you have a 401k worth $1 million, okay? You have some other investments worth 500 grand. So now you're over 2 million, and you have 2 million of life insurance, bang, you're going to be subject to 45% of the value of the estate between 3.5 and 10. Okay, so you will be subject to the federal estate tax. People don't realize that if you do not put your life insurance in an irrevocable trust, it will be part of your estate. 50% tax if you're between 10 and 50 million, 55% between 50 and a billion, and 65% of over $1 billion. So, hey, it's going to get expensive to be rich in America if this act passes. Now, again, I'm not sure it's going to pass. I do think there will be some estate tax legislation that will pass. I'm not sure it's this one, but I think we all can expect estate taxes to go up. And that's why what I've done is I've taken advantage of 2021. Nothing's going to happen, I don't believe, until the end of next year. So I think you're going to be grandfathered in if you do estate planning, as long as you don't die this year. So I would talk to a trust and estates lawyer. If you're going to have an estate worth more than $3.5-4 million, you need to call an estate and trust lawyer and start talking. I've done it. I actually started before this act was at least introduced, because I knew it was on the way. And it's not even expensive. There's some easy stuff you can do. What he's trying to do, there's another piece of part of this legislation, is he wants to end what's called dynasty trust. And that's what the Walton family owns Walmart's, what they did. And they basically just dump in a bunch of appreciated or stock that's going to go up and put it into in a trust and basically get it out of their estate. A dynasty trust is used to pass money onto multiple generation descendants while paying as little in taxes as possible. The trusts have no expiration date. There are no required minimum distributions, meaning the assets can grow an unlimited number of years. So this goes against what's called the rule against perpetuities. If you ever went to law school, took a real estate class, you know the common rule is a trust could continue for only 21 years after the death of the last beneficiary. So this kind of circumvents the rule against perpetuities, and the trust could theoretically last for 100 years or so. So some states have gone away from it, but depending on where you set up these dynasty trusts, you can keep these trusts going in pretty much perpetuity. And it's basically an irrevocable trust that you're able to dump in assets at today's value and have it grow without tax. And then people can just take whatever they want out and just pay tax on that. He wants to essentially limit its effectiveness by limiting what you can put in it. Generation skipping tax. This is another element that he wants to strengthen. But basically, he wants to design it to prevent avoidance of estate and gift tax by applying it with no exclusion to any trust set up to last more than 50 years. So he doesn't want you to be able to set up a trust that skips the parents, goes to the grandkids. The parents still control the trust, can pull money out, but it's not part of their estate. He doesn't want this to go on for hundreds of years. He wants this to stop at 50 years so that we'll get around what's called the generation skipping tax trust, the GST trust, which I've set up. Most people set them up. It's basically you're able to leave money to your grandkids. Your kids can still use the money. But the assets are part of the kid's estate, or the grandkid's estate, not your kids. So it's a very common estate planning technique, not super sophisticated. He wants to limit it to 50 years. So that's another proposal in this act. GRATs, which is a big one, grant or retained annuity trusts. And basically he wants to prevent abuses by barring donors from taking assets back from these trusts just a couple years after establishing them to avoid the gift tax. So basically, the Waltons did this also. This is a pretty big thing in the estate planning world. Grats, a lot of wealthy people have them. What Sanders wants to do is he wants to have a minimum of 10-year term and a 25% minimum value for the remainder interest. And just so whoever is interested, a grad is a financial instrument used to minimize taxes for estate planning, usually for large families. It's an irrevocable trust created for a certain term or period of time. The individual established into his trust pays a tax when the trust is established based off the values in it. Assets are placed under the trust, and then the annuity is paid out every year. When the trust expires, the beneficiary receives the assets tax-free. So it's really, really sophisticated, really common estate planning tool for the wealthy. Nothing too aggressive. It's legal, but it's a common tool that's used by trust and estates lawyers. So another thing Sanders wants to eliminate: grantor trusts. He wants to prevent wealthy families from avoiding gift tax by paying income tax on earnings generating assets in grantor trust. He wants to disallow basis step up on death for assets held through a grantor trust if the assets are not included in the grantor's gross estate at the time of death. So another part of the same common theme, whether it's grantor trust, dynasty trust, grats, the whole idea is, hey, you get the money out of your estate today at today's value, and the appreciation on future earnings will stay out of your estate, and in some cases out of your kids' estate. They can still use the principal or the earnings in the trust, but it's not part of their estate. So it's just a common theme of dumping assets in at lower value and having it grow without estate tax or not being subject to estate tax. So this is part of the overall aim of this act, is to eliminate all these workarounds. Another thing, he talks about valuation discounts, which are very common in family partnerships. You basically put in privately held interests into real estate partnerships or businesses at a discounted value and have the appreciation grow without being subject to estate tax. And he wants to eliminate or reduce the valuable discounts for transfers of interest for family limited partnerships. So again, all this is all based off the fact that he thinks the super rich are being able to pass huge amounts of wealth from generation to generation, not pay their amount of tax. So how much is this going to actually raise? So this is taking on a lot of attention in the media. I'm talking about it. Lots of attorneys are going to talk about it. How much money is this going to raise? Well, he estimates that it's going to raise about $430 billion in the next 10 years. However, other, more conservative approaches is it's going to raise closer to $230 billion. So it's money, but hey, we just spent $5 trillion in the last year. We're really attacking 4,000 taxpayers, maybe less, maybe a little bit more, but assuming none of them have any estate planning lawyers. You saw with the statistics, out of the 4,000 or so, less than half actually paid estate tax in that year. So you're going to raise 230 to 400 billion. It moves the needle. Are you doing more harm than good? Is it fair? Is it a fair tax that you're taxing people 3 times their income tax? They're paying tax on the income and then also on the value of what they pass. Maybe it is fair. I don't know. All I do know is I don't think it's going to have the impact Mr. Sanders thinks, because of the fact that there are a lot of smart attorneys out there, and there are a lot of ways to get around paying estate tax, especially if you're in a situation where, and most family wealth is tied into either appreciated assets like real estate or business interests. And if you have a situation where you are in a position where your assets are appreciating, you have the ability, so long as the act does not remove the power of trust, irrevocable trust, to push those assets in those trusts and then have them grow without being subject to estate tax. So there are always going to be workarounds. Life insurance is another way. You can put it in a revocable trust. It's not part of your estate. At least the amount paid off, maybe the value when you put it in, which is generally low anyways. So there's going to be workarounds. It's not going to raise that much money. It definitely is a good media play. It's going to get lots of clicks, lots of views, lots of listens. People like talking estate taxes. People like talking about billionaires and punishing billionaires for making money legally. Personally, I'm not a big fan of the estate tax. I think there's other ways to tax the rich and get more money, like potentially increasing, capital gains at certain thresholds, or removing step-up basis as death. There's other ways to do it where you're basically penalizing them when they sell the asset, but not just penalizing someone for dying. So I'm not a big fan of it. I think there's workarounds. I'm doing estate planning now. I think it's a great year to do it. If you're listening, watching on YouTube, call, and you think you're going to have an estate over $3 to $4 million, pick up the phone, call a lawyer, email a trust and estates lawyer. This is a great time. You still have plenty of opportunities to do some good tax planning, especially if you own real estate or a business that's appreciating, doing well. You have an opportunity if you're married, double up on the exemption this year, around $23 million, dump a bunch of assets in an irrevocable trust. You can actually still potentially control it. There's ways you can do it that you still have control, and it's going to be out of your estate and perfectly legal, not super risky. I was a corporate tax lawyer, so don't have a lot of experience in the trust and estates world, but I've studied it. I've done some work in the trust and estates world, but I can tell you there's some amazing lawyers out there all over the country that can help you, and it's not super expensive to do estate planning, and it's super well worth it to help protect your estate, because this could be the last opportunity for 10, 15 years to protect your assets from estate tax. Because I do agree, we're because of COVID, we've pumped so much money in the economy, and it's just bottom line, we're going to have to figure out a way to pay for it, and this is going to be something that will pass. No matter what happens in a few years in the House, I think they're going to get something done before it. There is momentum for estate tax. No one likes the billionaires out there, and Sanders did it on purpose. If you go online and Google for the 99.5% Act and pull up the actual PDF, you literally can look at every billionaire. He has every name from Forbes of every billionaire and how much they're worth, up to like over $1 billion, a little bit over $1 billion. So he wants you to know who they are. He's kind of shaming them. I'm not sure why. It's the American dream. These people earned it. They worked hard for it. We all can do it. I think we should be proud of them. I think personally, I look up to successful people. And do anything illegal. Is it too much money? Yeah, maybe. Who needs $1 billion? It's probably overkill, but they earned it. It's their money. We're only going to raise $200 to $400 billion in the estate tax over the next 10 years. We just spent $5 trillion in a year, so I'm not sure it's going to really move the needle. I think there's probably better ways to go get the money. But that's just my call. That's just my take as a tax attorney. I love this country. I believe in the power of freedom, democracy, and the ability that anyone in this country, no matter who they are, their religion, race, where they grew up, has a chance to succeed and make lots of money in America, and that's just a great thing. That's what separates us. So that's my take. I could be wrong. Again, I don't need $1 billion in my life, but if I did earn it and I did it legally, I think it's kind of unfair for the government to take 65% when I die. And if they want to do it, I'm going to hire a bunch of good lawyers who are going to make sure that doesn't happen, which is going to be the case anyway. So, that's kind of where we're at. I know Bernie Sanders, this is a area he's very focused on, and the progressives are just kind of going after billionaires. But at the end of the day, you're only talking 4,000 or 5,000 people. Not that much money anyways, and is it really worth it? The cost of enforcing this stuff isn't cheap. Maybe there's a better way to force rich people to spend their money and invest it. That may be a better way to use their money for good versus just taxing the heck out of it. So anyways, that's my take. Adam Bergman, IRA Financial. Hope you guys enjoyed the podcast. Definitely check out for the 99.5% Act. It's interesting, let alone if you just want to look at a list of really rich people. But I think this is a great opportunity. The real reason I want to do this podcast is just encourage people that believe they're going to have assets or estates over $3.5 to $4 million in the next 10 years. This is a great chance over the next 6-7 months. Go out and talk to a trust and estates lawyer. Go protect your assets and see what you can do potentially to use the very, very high exemption now. I mean, we're in a situation where if you're married, there's $23.4 million of cash exemption we can use to dump assets in a trust and get it out of our estate. So this is it. This is the last, the last go round for, I would think, 10 years or so before we're going to see an exemption this big again, maybe even longer than 10 years. So take advantage of it. And that's it. Stay safe, stay healthy. Hope you guys, have a nice holiday, and talk to everyone again soon. Be well, and thanks for listening. Thanks for watching.